All right, Ken Range Theory Trader back with you with another video talking about the 1-5 trading model. So let's get into it. The 1-5 trading pattern is a very simple pattern. It's a two candle pattern when we talk about the candle range theory. And the first candle forms at 1 a.m. on the 4-hour chart. That's the chart that we're using for our range. And it forms from 1 a.m. to 5 a.m. Eastern Standard Time, okay, during London session. You start trading, your trading hours are from 5 a.m. to 9 a.m. EST. All you're looking for, okay, based on this range, and this is a short example of it, what we're looking for. But all you're looking for is for a price to take either the high or the low of the 1 a.m. range and then close back inside of it for a reversal. And your take profit is the other side of the range. But the main thing is this: the 1 a.m. candle has to create the initial high or low of the day. And then after it closes, a new high or low of the day has to be made up here. Okay, see how this is the new high up here. And then you want to catch the momentum as it shifts downward and ideally just be out in one candle. Okay, so this is the price action that we're looking for. 1, 2, first high of day, new high of day, and catch the momentum going down. That's all. Okay, so again, just to reiterate, if that 1 a.m. candle that you look at does not form the first high of day, let's say the high of day was made at like 5, the 5 p.m. candle, you're not trading off of that. But I'll show you exactly what we mean. Okay, but it has to be the high or low of the day. So here's our decision flow for the 1-5 model. Number one, you start at 5 a.m. Eastern. It's during London session. You have to ask yourself, has the 1 a.m. candle made the current high or low of the day? If it has, you can continue. You can drop down to the 5-minute chart and has a new high or low been made? And if so, once that happens, you want to wait for price to close back inside the 1 a.m. candle range, and it has until 9 a.m. to do so. When all that criteria is met, you take the entry and your stop loss just goes above the high or low of the day. And if the price does not go back inside the range by 9 a.m., you can either shift it to a 9-5 model, which is also on this channel, or you can just ignore the pair because this could be trending. So what I mean by that is this. Let's say you have the first high of the day here and then price just keeps going up and does not close back inside of it. It could just be trending and you're just going to be on the wrong side of it if you try to take it short. That's what I mean by that. So you can use the mark levels indicator that will indicate the current high and low of the day for you. These are the settings. If you go to TradingView, type in mark levels, go to the settings, and all you'll need checked is the day, the open, swept, and current. And then that will put the lines on the chart for you. So let's take a look at the template here. When you come to the chart every day at around 5 a.m., you're looking at this range candle that forms between 9 and 1. I'm sorry, 9 p.m. to 1 a.m. And if it takes the high and then close back inside of it, then you are going to enter right there and then write it down to the opposite side of the range. And then on the, let's see here, for the long side, if you're looking at the 9 a.m. to 9 p.m. to 1 a.m. candle 4-hour range, again, you want to see price starting at 5 to go below the low of this candle, close back inside of it. This is between, and it only has 4 hours to do this. And then your take profit is just the other side of the range. Okay, that's it. That's all you're looking for. So these are some long examples. I wouldn't be, this is just what we're looking for right here. So we have a 4 a.m. range right here. Okay, so this is okay. It's only 2 candles. It's all you're looking at. Okay, I try to make it as simple as possible. It's very difficult to screw this up. All right, so this is the range. See how price pokes below the low. It makes a new low of day. This is the mark levels indicator. LOD stands for low of day. It makes a new low. Once price closes back inside the range, our entry is right here. And it backs up to the top. That's it. Let's see the entry on 5-minute chart. Okay, so here, price chops around. It breaks below it and then closes inside of it around 7:05. And typically you can expect about anywhere from 1 to 2 to 1 to 3 in terms of risk to reward ratio. Okay, I think this was about a 10 pip stop loss. For the most part, you can get away with a 10 pip stop loss on this. Sometimes they may be a little lower, but again, you want price to just go to the other side of the range. That's it. Okay, quick little trade. This one here, 1 a.m. made the first low of the day. The new low was created in the 5 o'clock hour. So we're going to see our entry on the 5-minute chart. And again, we want to see it. We want to be out in the next 4 hours. So we want to be out by 9. All right, before USA session starts. So always remember to take the meat of the move. Even if it doesn't reach quite all the way to the top, Don't feel like, oh, well, it has to get up there. Otherwise, no, man, just take your profit. Okay. Be happy with whatever you can get. And 1 to 3 is typically best. If you can catch a good move and get 1 to 3, this one trade right here was 1 to 3. All right. This was a 5 pip stop loss and a 15 pip take profit, but it's still 1 to 3. So if you take a $10 position and get 3 times that, you made $30. If you're risking $100 on this, you just made $300. So either way, it's still 1 to 3. So take what you can get. But this was on Euro Pound, which is a low ADR pair, so it doesn't move a lot. So let's take a look at one more here. So this one here, this was a 3 candle pattern. So the low of the day was set at 1. Price went below and closed inside of it in the next 4 hours. So this is still okay. It's just that it didn't happen in 1 candle, so sometimes it'll happen in 2. And that's what happened here. So your entry would have been around 730, 750. It gave you multiple chances to get in with this consolidation here. Price went inside the range, back out, inside, a little bit back out, and then just kept going. The non-negotiable is at the low of the day that was created right here. This candle right here, this low of the day has to hold. The low of the day that was created in the 5 o'clock hour has to hold. Okay, if that gets rated, the trade is invalid and it may just be a trending market and it could keep dropping. But as long as that low stays intact, you're good. So don't let all this scare you out of a good trade. Don't let all of that scare you. See how that low just held out right there? So yeah, it was just soliciting shorts. Everybody who went short here got killed. Everybody who went short there got killed. Everybody who went short there got killed. Shorts there got killed. Shorts there got killed. Shorts there got killed. Okay, because they were going against the trend. So that's what you're looking for when it comes to this range. The low of the day is your main pain point. All right. So stop loss goes below the low of the day. Okay. So here's some short examples real quick. So 1 a.m. creates that first high of the day. New high of the day gets created right here. So we'll drop down to the 5-minute chart. The entry was at 8:20 a.m., which is still fine. 1 to 3. And remember to scale in and add your positions. Okay, so this was your entry right here when price closed back in. You could have got in here as well. It did come out a little bit, but remember, as long as the high of the day holds, you're good. So when it comes back outside the range, don't get too frightened. The only thing that should concern you is if the high of the day gets taken out. Other than that, it may poke out a little bit, but that's just to solicit some more folks to go long before they go take the market down south. Okay. So this one right here, we have the 1 a.m. candle creating the initial high of the day. We have a new high of the day created in our time window between 5 a.m. to 9 a.m. and price tanks down. So let's see our entry. Again, we take the meat of the move. We got our high of the day here that was created. You could have got in at 655, 715, or 825. This consolidation gave us plenty of time to see if we wanted to get in or not. And once again, we don't let this price action concern us because the high of the day still holds and it hits the opposite side of the range. This was good for 1 to 2.5 risk to reward. So not quite a 1 to 3, but anywhere from 1 to 2 to 1 to 3, you should be able to get that with some consistency. This next one. Okay, so we have our initial low of the day, or I'm sorry, high of the day right here. And then it just pinned it just a little bit, and this was perfect. See how this was our 2 candle pattern. Okay, so bang, bang, and you're out. Okay, so let's see the entry. This gave us a 1 to 3. Price barely hit the range there, right at 535 to 545. You kind of had a second chance on this retrace to get in, but you want to be in before you see that momentum really pick up and hit the daily open. Daily open is also can be a good price take profit level as well, depending on the trend overall. You don't have to worry about it too much, but once price sometimes hits the daily open, it can retrace some. So be on the lookout for that. But for the most part, this gave us a 1 to 3 as a result of, once again, the first high of the day and then the second high of the day, and then price just spiking down to the low. All right, spiking down to the low of this range. Okay, so that's your move. You're out in 4 hours, less than 4 hours. Okay, so that was just a pretty quick trade. It's only 2. That's all you really need. Okay, so in conclusion, risk management is still number 1. You can always have the direction right, but still get margin call because you take on too much risk. It is not trading that gets us paid, it's risk management, okay? Do not start trading this model until 5 a.m. and beyond, okay? It is only good for 4 hours. If your setup does not appear by 9, there is no trade, all right? In terms of risk to reward, you can get as little as 1 to 1.5, 1 to 3 max, okay, on these trades. So just have that in your head. Don't let a winner turn into a loser. Don't let like this right here, okay, yeah, price didn't hit the end of the range. Okay, it didn't hit the take profit range, but you still could have got 1 to 2. Be happy with that. All right. It didn't hit this green line. That's fine. But you see, look at this. Look at that steady price action. But we don't know if price is going to keep going up or not. We don't know what the next candle holds. So ideally, you want to be out before New York session starts, because sometimes New York does reverse and you could be on the wrong side of a trending market. Take what you can get. Okay. Take what you can get. Okay, so like I said, ideally the take profit, or at least you should have a decent return by 9 a.m. All right. If it doesn't work out by 9, you shouldn't hold anything longer than 1 p.m. That's 2 4-hour candles. All right. That's at the latest. Take whatever you can get by 1 at the latest, but ideally 9 a.m. You're out of this position. This model isn't done. Okay. Again, if your setup does not play out by 9, you can then shift to the 5-9 model. If you don't know what that is, you can look at the video called Secret CRT Model Exposed on this channel. And it's the same thing. It's just the time shifts over by 4 hours. That's it. Okay, so you want to be done in 1 hour, but you can wait for 2, or 1 candle rather, but you can wait for 2 if that doesn't happen. All right, so I hope that was easy enough to explain and easy enough to understand. If you have any questions or comments, though, you can leave them in the comments. Don't forget to like and subscribe. I thank you for watching, and have a great rest of your day.